current leading technology from ASML has a resolution of around 8 nanometers. Despite these advancements, Chinese companies are still working to close the gap with global leaders like ASML, especially given the US sanctions that have restricted access to advanced semiconductor equipment.
China continues to dominate critical industries despite continued efforts by the United States, from breakthrough in chip-making technology to its stranglehold on the rare earths market. The West is struggling to catch up with China's critical mass.
China's $200 million impossible chip breakthrough is rattling the globe, upending once stable alliances and leaving the West in a scramble. In the past week alone, leaked figures from late last year confirmed that China's domestic lithography has made astonishing leaps, narrowing a technology gap many analysts deemed insurmountable. Meanwhile, tensions spike as Western officials impose fresh restrictions aimed at containing China's colossal rise. Investors worldwide now keep one eye on currency markets and the other on short-term funding data, bracing for further surprises. Yet, the urgency doesn't end with Silicon Valley or Shenzhen. Worldwide, families face higher grocery bills, and energy markets teeter on uncertainty. With every fresh headline, the stakes grow bigger. Brace yourself, because this semiconductor standoff has mutated into a full-scale economic battleground. For years, the United States tried to constrain China's tech ambitions by banning advanced chip equipment and restricting exports.
Stern protests with the US for its update of the semiconductor export control measures, sanctions against Chinese companies, and malicious suppression of China's technological progress.
Unexpectedly, those same restrictions ignited fierce innovation. Beijing funneled hundreds of billions of yuan and recruited tens of thousands of top engineers, many from Silicon Valley, to fast-track domestic alternatives. Recent data, released 3 days ago, highlights sub-7 nanometer breakthroughs achieved solely with deep ultraviolet lithography, stunning an industry that had banked on China's perpetual reliance on Western tools. This conflict goes far deeper than circuit boards. Soon after Washington escalated chip bans, China retaliated by dumping United States government bonds and slashing orders from tech pillars like ASML and TSMC. Stock indices reacted violently. European policymakers, already wary of losing their biggest chip buyers, scrambled to contain fallout as ASML's earnings reportedly plummeted by over a quarter in the final months of last year. The tensions don't stop at the manufacturing floor. Tariffs on Chinese goods, now rumored to reach 104%, spark new anxieties about inflation, job security, and consumer choice. Critics warn that ratcheting up the chip war and trade barriers simultaneously is a recipe for global disruption.
And the Trump administration put sanctions on certain companies, and this ensured that companies which were tied to Huawei and who were the ultimate suppliers of Huawei could not get the semiconductor chips that they needed, and this particular sanction remains in place.
And the ripple effects are already rocking commodity markets. National pride now collides with rising prices everywhere, creating an explosive mix that threatens to reshape alliances and accelerate an economic showdown few can escape. The battleground is vast, and the stakes demand center-stage performances from the world's most influential players. China emerges as a formidable contender, no longer satisfied with being the workshop of the globe. Officials in Beijing have poured billions of dollars into state-backed chipmakers, from the upstart Shenzhen-based Seekar to the increasingly dominant Yangtze memory technologies. At the heart of China's strategy is an unbending desire to become self-reliant in semiconductors, evidenced by its breakneck pivot towards 7 nanometer chips. Despite new data indicating a lingering gap in some advanced nodes, China's push forward is relentless. On the other side of the Pacific, President Trump doubles down on tariffs not only against China, but also against traditional allies like Canada and the European Union. His administration targets 140 Chinese companies, along with potent measures on Canadian steel and aluminum. In the last few days, rumors abound that the White House may expand tariffs to an unprecedented scope across several consumer imports, testing the loyalty of importers who rely on cheap parts to remain profitable. Meanwhile, top officials in Ottawa issue veiled threats about redirecting vital oil exports away from the U.S., potentially igniting an energy crunch that could push American gas prices sky high. Enter the high-stakes drama of TSMC and ASML, two pillars of global chip supply. TSMC built its reputation as the crown jewel of Taiwanese tech, while ASML, based in Europe, holds the keys to the world's most advanced lithography machines. Until recently, these companies were indispensable. Then came Beijing's sudden shift, slashing orders and declaring a bold independence from Western technology. ASML's quarterly revenues dropped by nearly a third toward the end of last year, and TSMC's future projections took a grim turn. EU leaders, desperate to protect a flagship industry, now find themselves caught between a rising China and an emboldened White House. As if that weren't enough, tension flares within Europe itself, where countries debate the wisdom of retaliatory tariffs that could boomerang on local industries. Adding to the precarious mix, American farmers and fishers feel the sting of reciprocal duties.
Fertilizer, fuel, herbicides, machinery, all have gone up.
Basic goods, from bananas to coffee, show rising price tags, fueling public discontent. In farmland communities, fears of a severe blow to exports have some folks wondering if Washington's tactics are sacrificing homegrown stability for national prestige. In factories from Michigan to Texas, workers slam the sudden spike in material costs, worried about layoffs if retaliatory measures escalate further. Could a 104% tax on Chinese goods spark a global recession? That question lingers as these powerful players march deeper into conflict. Investors monitor global stock tickers, uncertain whether the next wave of bad news will topple the precarious balance. The collision of technology embargoes and sweeping tariffs is sending shockwaves through every corner of the world economy. European markets, heavily intertwined with both American and Chinese trade, have taken a substantial hit. In Germany, once celebrated as an industrial powerhouse, government officials are grappling with the reality that their largest automotive and industrial clients face uncertain supply lines. A switchback to coal signals deeper anxieties about energy independence, fueling accusations of hypocrisy after lofty green pledges. Meanwhile, Canada's tough rhetoric hints at a major supply rerouting. Prime Minister Danielle Smith, paraphrased in recent remarks, floated the possibility of diverting millions of barrels of crude oil away from U.S. refineries. Even the suggestion of a pivot in Canadian energy flows has raised eyebrows on Wall Street, where some analysts warn that abrupt realignments could trigger yet another commodity price surge, hammering American consumers at the pump. Those same consumers, already paying more for everyday groceries, fear that gasoline spikes may be the final straw. At the same time, the currency front offers little solace. China's decision to dump U.S. government bonds rattled global bond markets, raising yields and threatening mortgage interest rates that could hurt working families. A few days ago, a new wave of data pointed to a global investor exodus, with large sums fleeing American tech stocks in favor of riskier emerging markets. Critics label it a junk bond apocalypse in the making, hinting at potential corporate debt storms if credit downgrades spread. All of these developments feed into an atmosphere of persistent unease as policymakers from Brussels to Tokyo brace for the next market jolt. Then comes the question of rare earth minerals, vital to electric vehicles, smartphones, and military hardware. China's near monopoly in these critical elements sets the stage for an ominous power play. By restricting exports to unfriendly nations, Beijing signals its willingness to wield resources as a geopolitical cudgel. The potential chain reaction is enormous. Factories halting EV production, tech firms scrambling for alternative suppliers, and militaries rethinking their weapon systems. This deeper layer of resource competition reveals a long shadow over any hope for rapid resolution. The last few days have seen no easing of this stance, Rather, some Chinese state media outlets hint at further tightening, an unmistakable reminder that global supply chains remain newly fragile in a high-stakes climate. Where do we stand now? Official statements from Washington, D.C. have emphasized the need for fair trade over unrestricted expansion, signaling an unwavering posture that leaves little room for immediate compromise. On the Chinese side, headlines broadcast progress in NAND flash memory, advanced chip packaging, and full-spectrum supply chain integration, further reducing the need for Western imports. Any talk of negotiation feels overshadowed by bold steps toward decoupling. Recent analyses, released this week, suggest that both nations are nearing a point of no return. The U.S. might soon pass new legislation formalizing the ban on advanced lithography exports, while China leans ever closer to restricting the flow of rare earth materials essential to everything from fighter jets to electric SUVs. Meanwhile, the European Union, stung by trade barriers, edges closer to backroom deals with the U.S., hoping to shield crucial industries like aerospace and automotive. Multiple European officials fear a total meltdown if key players can't de-escalate fast. Capping it all off, financial jitteriness has grown more acute with each passing day. Intel's planned chip expansions in Ohio remain in limbo amid uncertainty over capital injections. Corporate debt watchers warn that if these tensions persist, a wave of junk bond defaults could hit tech, infrastructure, and energy projects. Negotiations, if they materialize, must address a host of intertwined issues: tariffs, intellectual property disputes, energy flows, currency moves, and the entire matrix of semiconductor supply chains. So, is the United States on the brink of a junk bond apocalypse? Are we condemned to a fractured global landscape where tariffs never end and critical resources become bargaining chips? Each day brings a fresh volley of news, from China's unstoppable push towards self-sufficiency to Washington's unwavering stance on punitive measures. The result is a precarious moment that may define modern economics for decades to come. Where nations once cooperated for mutual gain, they now tread a tightrope between compromise and outright economic war. The world's factories, markets, and families hang in the balance. As the dust settles on this latest round of revelations, the question isn't just who will win the semiconductor race. It's whether the entire global financial system can withstand such brutal shocks. Only time will tell, but tonight, the tremors of this conflict echo louder than ever.